The story of FTX is one soiled in lies, deceit, mismanagement of funds, and even more lies. Through misappropriation of funds, terrible accounting, and undocumented transactions, FTX founder Sam Bankman-Fried, who many dubbed the savior of crypto, may leave more than 1 million investors with no way to get their money back. FTX was supposed to be one of the world's most reliable and most trusted crypto firms. So, what happened? Meet Ryan. Ryan had first heard about a problem at FTX on November 6th, but he dismissed it as FUD, a term used by crypto circles to describe uncertainty, baseless fears, and doubt. Samuel was confident that FTX was bulletproof and there was no way his money could be in danger. And when FTX founder Sam Bankman-Fried tweeted to his 1 million followers on November 7th saying FTX is fine, assets are fine, it was everything Ryan needed to reassure himself that nothing was wrong. After all, this was the crypto king, the crypto savior, the man who had bailed many crypto firms from going bankrupt. Ryan had no idea then, but he was making the biggest mistake of his life. By November 8th, just one day after SBF had tweeted this, news reached Ryan that FTX was falling apart. Ryan rushed to withdraw his funds only to discover FTX had suspended withdrawals. His hands began to tremble. How would he withdraw the $25,000 in assets he kept in FTX? The money was equivalent to a decade's worth of savings, and now everything was gone. FTX was the second biggest player in the world of crypto after Binance, with a net worth of over $30 billion. So, where did all that money go? Or could it be possible that there was no money in the first place? If that's true at all, could it mean we're looking at one of the greatest Ponzi schemes of all time? This is the story of the dramatic rise and fall of FTX. Sam Bankman-Fried, or SBF, was born to two Stanford law professors, Barbara Fried and Joseph Bankman, on March 6, 1992. From a tender age, SBF enjoyed solving problems and taking advanced classes to get ahead of his peers. During summer breaks in high school, when his mates were busy partying hard and chasing girls, SBF attended maths camps where he spent most of his days crunching numbers. In 2010, he got accepted at the prestigious Massachusetts Institute of Technology, MIT, and that didn't come as a surprise due to how good he was with numbers. There, he majored in physics and minored in mathematics until 2014, when he earned his degree. But before graduating from MIT, Sam had stumbled upon investment trades, which unsurprisingly also had to do with something he loved: numbers. The topic intrigued him, so Sam learned more about it. So, in 2013, a year before he finished his program at MIT, he got a job as an ETF trader for Jane Street Capital. There, he learned the basics of the trading world and came to terms with the financial world. This was shocking to the people who knew Sam. Everyone had expected him to follow in his parents' footsteps in academia, but he'd fallen in love with trading, so he decided to pursue a future in it. Sam worked with Jane Capital Investment for 4 years. He stumbled upon something that would have a big influence on his future: the art of arbitrage, a form of trading that allows traders to buy an asset for a low price and then sell it for a higher price in another market. This would play a huge part in his future. By 2017, Sam had gotten bored and tired of working at Jane Capital Investment, where he did the same thing repeatedly. However, that's not the only reason Sam quit his job. You see, SBF was getting increasingly frustrated with his job around the time. It was a completely different market from the world of stocks and everything he was familiar with. The endless possibilities of the crypto market also presented him with an opportunity just too much to pass. So, Sam quit his job that year and went fully into the next stage of his life: crypto. In November 2017, just a few months after leaving Jane Street, he established his own trading firm, Alameda Research. The company was a quantitative trading firm, similar to what he'd done at Jane Street. And then, in January 2018, he stumbled upon something that changed everything forever. Back in 2017, crypto was making waves in the US. Everyone from lecturers in school to stockbrokers, celebrities, and random folk were investing in the new currency. Sam was also interested, as the new currency was breaking new records daily. So, Sam invested some of his savings in Bitcoin without thinking too much about it. It was nothing huge, a little savings he'd gathered while working at Jane Street. But that would change in 2018, when he made a life-changing discovery. In January 2018, 2018, Sam discovered that the price of Bitcoin on Japanese exchanges was higher than in the US. Immediately he realized this, a light bulb lit in Sam's head. He thought of all the fortune he could make by exploiting this difference in international value. Wasting no time, Sam began trading Bitcoin using the resources he had access to at Alameda Research. He would buy huge amounts of Bitcoins in the US and sell them in Japan for a higher rate. He traded up to $25 million worth of Bitcoin daily with that method. It was not exactly legal because he had to bend several rules to be able to do that. Still, Sam had learned so much from his former workplace, so he had the resources to trade comfortably. But, like most people, Sam didn't mind taking advantage of the market if it meant achieving his goals. And because of this, it didn't take long for Sam to trade and make millions worth of crypto daily. One of the dubious ways Sam achieved this was by naming his country Alameda Research, rather than anything that concerns coin, blockchain, or trading. With research at the back, people felt comfortable using and investing in his platform. After all, who doesn't want to invest in a research institute? It was so profitable that the company earned about $10 to $30 million within a few months. But Alameda Research was not a big enough platform for SBF or his dreams. He needed something bigger. He wanted a platform that could trade internationally, something that wasn't so common. So, for his next move, Sam created FTX in the spring of 2019. Like Binance, FTX was a modern cryptocurrency trading platform that offered features for trading, studying the crypto market, and many other things. Using modern features unavailable in most trading platforms, SBF attracted high-risk traders willing to invest heavily in crypto. But providing new features would not be enough to attract the giant risk takers he wanted, and these investors would normally not want anything to do with crypto. And that's where Sam's master plan comes in. When you consider Sam Bangman-Fried, he looks like a regular nerdy bloke. His choice of clothes and personality is similar to the likes of the Facebook founder Mark Zuckerberg and Microsoft founder Bill Gates. This appearance made most people want to trust him. Sam, at the time, was worth a lot of millions. But Sam took a different approach. Rather than splashing his money on a fleet of cars or other ridiculous expenses like most crypto billionaires, he drove around with a Toyota Corolla and invested a lot of money into multiple PR schemes. Using his money, Sam painted himself as a humble geek seeking to create a better world. He would also go on numerous podcasts explaining how he wants to give 99% of his wealth away. This eventually paid off as investors and celebrities worldwide invested in FTX. Companies and firms such as Pantera Capital, Galois, SoftBank, and Altimeter Capital Management all poured money into FTX. And the more money he got from the investors, the more money he pumped into his PR schemes. He got celebrities like Tom Brady to come on board with him, did numerous adverts, sponsored one of the most powerful F1 teams, Mercedes, and even bought the naming rights of a basketball stadium. And while most crypto billionaires tried to stay out of the public light, Sam embraced it. He appeared on numerous magazine covers, talk shows, and podcasts, where he went on and on about his business and how he wanted to save the world. He was even one of the biggest donors to Joe Biden's campaign, another PR stunt on full display. By 2021, the crypto market was at an all-time high, and investors worldwide were looking for a safe crypto platform to invest their money. Sam pumped more money into his ads, and soon enough, FTX rose to the top of the crypto chain. It was the name you saw everywhere. And when these investors Googled FTX, Sam's name came up, as did news of his philanthropic work, his ads, and his face on magazines. It was all just too good to be a lie, meaning more people began investing in FTX. Soon enough, Sam became the richest billionaire under 30. Even Binance, the biggest cryptocurrency platform in the world, invested in FTX, which helped to give Sam even more credibility. But Sam wasn't just building an image, he was building connections with powerful people. All this allowed people to look past all the red flags about Sam Bangman-Fried, his company, and how he managed the billions of dollars they'd invested in his company. One red flag was when Sam broke company rules to date one of his employees, Caroline Ellison. But this wasn't just any woman. Caroline had once confessed on air that she was on amphetamine, a highly addictive drug that stimulates the central nervous system. The both of them continued their on and off relationship for many months. So it didn't come as a surprise when Caroline was promoted to co-CEO of Alameda Research in 2021. She'd gotten the post alongside Sam Trabucco. Then in 2022, Trabucco stepped down and Caroline became the CEO. Another red flag was perhaps news of Sam's unethical playing games and not paying attention during important meetings. All these were signs that something wasn't particularly right at FTX. For a business worth over $30 billion, it felt like kids were running it. Caroline becoming CEO of Alameda Research also raised many questions. People questioned the credentials Caroline had to hold such a position, and what did that position mean for FTX? Before that time, Sam had told everyone that Alameda Research and FTX were separate companies, but everyone knew they were more connected than he would admit. But with more questions, especially about how connected Alameda Research and FTX were, Sam Bankman-Fried knew that keeping quiet about it would only hurt his company's credibility. So, once again, he went on numerous podcasts to explain how it worked. But the more Sam talked about his company and how it worked, the more it seemed like a big Ponzi scheme, with Sam at the top of it all. Now, Ponzi schemes are not a new concept. It's a form of fraud that lures investors by creating a business with low risk and insanely high profits. The first set of investors earn what was promised, but the funds are gotten from the more recent investors. Then it becomes a circle and continues until the fraudster decides he's had enough, and everything crashes and burns. Sam had left enough clues out there that everything was a fraud. How come no one saw it? The beginning of 2022 was particularly good for FTX. The company raised $400 million in Series C funding, and new investment saw the company's value catapult to $32 billion. This meant FTX was only second to Binance. With FTX breathing down on their neck, Binance began to feel the heat. And while both CEOs, Changpeng Zhao and Sam Bankman-Fried, would shake hands publicly and pretend everything was great between them, the reality was that they were far from friends. None of that would matter when the crypto market crashed in the middle of 2022. $200 billion disappeared into thin air, with several crypto companies going bankrupt. While every other crypto company or firm struggled, Sam said FTX was fine. He even volunteered to help struggling companies find their feet by contributing millions of dollars to the companies. But that was far from the truth. FTX was struggling, but Sam didn't want his investors panicking. He needed the crypto rates to remain stable, or FTX would have been grossly affected. So Sam pulled in resources he didn't have and made those changes. But while Sam was parading himself around as crypto's white knight, saving other crypto firms, things weren't great at FTX. Meanwhile, the relationship between Sam and the Binance owner was getting worse. But Sam didn't care. He was at the top of the world. However, Sam Bankman-Fried didn't know that his world was about to come crashing down, and that Binance was going to have a hand in it. The beginning of the end for FTX started on November 2nd, 2022. That day, a report about Alameda and FTX's balance sheet was leaked on CoinDesk. The report showed that a major part of the company's assets were stored in FTT, a coin minted by FTX. In other words, FTX had money and at the same time didn't have money. To explain things better, the company had huge amounts of money tied up in several projects, so it couldn't be withdrawn or accessed when needed. Some experts even claim that some coins or assets the company's funds were tied in were not all valuable, and that the company was probably covering its insolvency by minting coins from thin air. Caroline quickly defended Alameda's resources and said they paid off a major part of their loans, and some of their funds were not on the balance sheet. But while all this was happening, Binance and its CEOs were waiting for the perfect opportunity to strike. After CoinDesk leaked Alameda's balance sheet, the cryptocurrency platform decided out of the blue to sell all its equity in FTX for FTT coins, and then move to the Binance account. A few days later, Changpeng Zhao, Binance CEO, announced that the company wanted to sell their FTT coins worth about $2.1 billion in the free market due to recent revelations. This was strange because Changpeng Zhao was aware of this move's effect on FTX, and yet he went ahead with it. In his defense, Zhao claimed the coins would be sold slowly to have minimal impact on the market and not hurt FTX. But the truth is, Zhao was slowly setting up the downfall of FTX and getting rid of his competition right in front of everyone. Realizing how this would affect FTX, Alameda Research's CEO Caroline quickly contacted Binance to sell all of the FTT coins to them at $22 each. This was a reasonable price, and had Binance agreed, it would have stabilized the price of FTT. But rather than do that, Binance declined. And although Zhao claimed that he had taken this step without intending to hurt FTX and his long-term rival Sam Bankman-Fried, the rejection proved otherwise. With Binance refusing to sell their FTT coins, the price of FTT dropped by 80%. And so, in a few days, FTX and Alameda had lost billions of dollars. Anyone can lose money. While this is true in every sense, customers see that this was different from losing a few million or billion due to a bad deal. Sam Bankman-Fried and his FTX empire was burning up in flames, and this was only the beginning. After seeing the price of FTT drop, everyone withdrew their money from the platform. According to a crypto analytics firm, Nansen, about $451 million worth of stablecoins was withdrawn from FTX over a few days. Left with no choice, FTT was eventually forced to freeze withdrawals. The company had run out of funds to pay their customers. Immediately, the company froze their account and people panicked. People who had invested all their life savings in FTT asked questions, and for the first time, Sam was quiet. Although he later came out to tweet, "FTX is fine, assets are fine." It soon became clear that this was all a lie, and the post has now since been deleted. On November 8, 2022, Sam confirmed that the company was struggling. According to the billionaire, the company was suffering a liquidity crunch. He also asked Binance to help by buying out the company. Surprisingly, Changpeng Zhao agreed, but the twist here was that he added a clause that allowed Binance to pull out of the deal at any point. When the internet got hold of this new development, it seemed like FTT would be saved after all. A few days later, things took another turn when the US agencies announced they'd been investigating FTX for some time for mismanagement of funds and fraudulent practices. After this announcement, the FTX website went off for 9 hours, while Binance announced they would pull out of the deal to buy FTX. From that moment, things only got worse. While they were still trying to figure out what was happening, hundreds of millions of crypto assets mysteriously disappeared from FTX's wallet without any trace. No one could explain how it happened, but one thing was clear. This was an inside job. For Sam, he was at the most difficult phase in his life with nowhere to run or hide. Just a year ago, he was in front of magazine covers and billboards, having been crowned the crypto king. And once again, he was getting all the attention he liked, donning TV screens and front magazine pages, except this time for the wrong reasons. With FTX burning up flames, Sam stepped down as CEO and FTX filed for bankruptcy. As FTX collapsed, the truth about Sam Bankman-Fried and all his shady schemes came to light. But SBF directed FTX executives to move Alameda's $8 billion in liabilities to an unknown customer account. This customer account had no email identifier, and SBF himself called the account our Korean friends account. But it gets even more interesting, as notes tied to this account were labeled FTX Fiat Old. This allowed Alameda to hide its negative balance on FTX, and the account has the same privileges as those of Alameda accounts. This includes exemption from liquidation characteristics. In light of this revelation, coupled with other allegations such as fraud, mismanagement of customer funds, securities fraud, and money laundering, SBF, together with Caroline Ellison and Gary Wang, were whisked away in cuffs. Caroline and Gary quickly pled guilty to get plea deals, leaving Sam to his fate. He is still trying to prove his innocence, but he's doing so in the comfort of his parents' house, as he got bail of $250 million that he easily afforded despite claiming to be bankrupt, and was placed on house arrest. With all these charges piled against him, his current jail time is about 100 years. The possibility of him getting the full punishment is slim, but it's only fair that those who lost their life savings just because they trusted the White Knight get justice.